What if I told you your portfolio's average return could be 10% and you could still end up with zero growth? All right, welcome back to Retire Stronger Podcast, episode 10. And today we are going to break down money markets and everything in between. I'm one of your hosts, John Foard, and with me today is my co-host, Bill Kearney. Bill, say hi to everyone.
John, good to see you. Good to be with you and good to be with everyone out there.
Absolutely. So today, Bill, episode 10, we're going to talk about average return versus compound average growth rate, or otherwise known in industry jargon, CAGR. That's CAGR, CAGR for short. Why it matters for your investments. So today, again, we're diving into what we consider to be a deceptively simple but critically important topic. What's the real difference between average returns and compound annual growth rate? And why does it matter so much for your portfolio? If you've ever seen flashy ads claiming 12% returns or heard someone say the stock market averages 9 or 8 or 10% per year, well, today's episode is for you. Because the truth is, folks, those numbers can hide a lot of risk and reality. So let's just kind of break down a little bit of the basics and define what we're talking about here between average growth rate and average returns and compound average growth rate. So again, let's start with some of the basics. First, what exactly is average return? So Bill, basically, I'm just going to kind of go through what this is for our folks that are listening out there. Average return, it's simple. You basically add up all of your returns over time, and you divide that number by the number of periods. So if it's a 5-year period, you add up the return for each of those 5 years, you divide by 5, and you get what is considered your average return at that point. So mathematically, this basically goes back to elementary school, right? It's what we learned a long time ago, the arithmetic mean. So, and that's all an average return is. So if you have each year's returns or each period return, you divide by the number of periods or number of years, and that's going to get what your average return is for your investment portfolio. So now, what about CAGR, or again, compound annual growth rate? So compound annual growth rate tells you the true rate at which your investments grew, assuming the growth was smooth and steady and compounding every year. And for everyone out there, just understand it's not just averaging the ups and downs, it's measuring the actual journey that your money took throughout the process and throughout the time frame. And quite frankly, folks, when you're talking about investing, the journey matters. So now I'm going to kind of go through a little bit of why average returns can be misleading. And we're going to talk about this. And Bill, I'm going to quiz you, Bill.
Oh, no.
Yep. So you didn't know there was going to be a test today, did you?
No, and I certainly didn't study for anything, so we're going to see how this goes. No promises.
Yeah, we're gonna test your knowledge and your math skills here. So, all right, imagine you had $100 that you wanted to invest into some type of investment, and so you invested the $100, and in year one, you gained 100% return on your investment. How much money do you have at the end of the first year if you invested $100 and you gained 100%?
All right. Got $100. I gained 100%. This is not a trick question, right?
It's not.
Okay. You're not trying to make me look foolish.
I am definitely not.
Okay. So in that case, I would say $200.
You are correct, sir.
Okay,
winner,
good.
winner, chicken dinner. All right.
I'm starting to get some confidence here. I like this.
Yes. And so, all right, let's continue this process. Now we're starting year two. We've got $200. We started with 100. Now we have 200. But in year two, the market has a bad year, or the investment you're invested in has a bad year, and you lose 50% of its value. Now, again, you started with $200 at the beginning of year two. At the end of year two, after losing 50%, what is the value of your account?
So I had 200, lost 50% of that. So I'm back down to where I started, right? I've got $100.
That is absolutely correct.
I'm
Again,
getting the
folks,
hang of this now. I like where this is going. Okay, keep going.
well done. So, if we are going to calculate what your average return was for that 2-year period, now, albeit, folks, I know that those of you that are out there listening, we're talking about a very short time frame here, and we're doing this as for illustrative purposes, and we are making this a very extreme example on purpose. So, you had your 100% gain in year one.
Yep.
You then had a negative 50% gain in year two.
Mm-hmm.
Your total return for that time frame was 50%. But if you divide it by the number of years you were in the investment, which was 2, I don't know if your math tells you the same thing, but my math tells me that the average rate of return equals a positive 25%. Would you agree with that
Um,
math?
absolutely not. We've got a problem. We've got a problem here, John.
Yeah.
I have the same amount of money I started with after 2 years. How in the world do I have a 25% return?
Right, because the way that you calculate average return, first of all, I agree with you. You have a 0% return from a real return perspective. You started with $100. At the end of 2 years, you ended up with $100. So you didn't lose anything and you didn't gain anything. However, when you do the math behind how you calculate the average return of your investment, that average return says that you have earned an average of 25% per year because you had a 100% gain in year one. You lost 50% in year two. So 100 minus 50 equals 50. 50 divided by 2 equals 25. So that's your average return per year based on how you calculate average returns with investments. And that is why, folks, we talk about how this is a very misleading um, number or statistic to look at when we're talking about how you calculate the return of your investments and why you need to make sure you understand the true and actual return of a potential investment or portfolio you're looking to invest in. Um, this is because negative returns hurt you more than positive returns help you. So, for example, a 50% loss needs a 100% gain just to break even. Volatility eats into real returns in a significant way. And that's why average returns, especially when volatility is high, can completely misrepresent how your investments are actually performing. Now, Bill, I know you're chomping at the bit over there to jump in and kind of talk about CAGR because, CAGR, or again, folks, compound annual growth rate, is a topic we harp on quite a bit with our clients and making sure they understand what their actual growth is. So I've been doing a lot of talking so far. I'm gonna throw it over to you, Bill, and let you kind of jump in and talk about how and what CAGR is and how it works and the power of what it does.
Yeah, well, John, we'll get there, but I've got a question for you. So, you know, as my investment advisor, you returned zero for me over 2 years. You're claiming that I had a 25% return. Are you able to actually disclose that that's what my return is
Oh, that's a great
legally?
question. That is a
Can
really,
you
really good
explain that?
question.
Because that's got to be confusing for some folks.
Yes, it's a great question, and I'm actually glad you brought that up because yes, as if you look at the different mutual fund companies out there or investment firms that are out there, they are legally allowed to display what their average return is on their documents, their fact sheets, anything they put out to the public. They are legally allowed to tell you that that's what their investment return was. Now, again, we were using a very extreme example, and we'll talk about more realistic examples, and we can share some of those with our audience at your request. But the reality is, average returns are legally acceptable and are allowed to be used when displaying how the performance of a specific advisor or investment companies is doing.
Okay, so let's put a pin in that right now. We're going to come back to that in a minute, but
Yep.
I want you folks listening out there to think as an investor and as a consumer of financial advice. We're going to come back to why that matters here in just a little bit. But let's talk about our hero, because if that average return isn't a true indicator of what's actually happening inside of my portfolio, something else has to be, right? Math has to have an answer here. And so CAGR, as we talked about it, the compounded annual growth rate, which, you know, a really bad dad joke here is a CAGR is just a kegger that grew up and graduated college. And so, yeah, that's really what we're dealing with here. This is a more mature way to do math and to see what's going on inside your portfolio. So CAGR is taking the starting value, your ending value, and how many years it took to get there, right? Our journey. That's it, right? So it cuts through the noise of good years. It cuts through the noise of bad years and wild swings in the market. It tells you what your steady compounded annual rate would have been through all of those. So let's do a real world example again. John, I'm going to make you on the hot seat here for this particular example. So you invest $100,000, right? Year one is up 30%. Guess what, John? You're not going to have to do any math. That's the great part about this. You're just going to have to listen. So year one, you're up 30%. Year two, you're down 20%. Year three, you're up 10%. I'm not going to ask you to do the math in your head on all those numbers, John. I know you could do it, by the way. You're super smart. I know you could do it. But your average return in that example, year one, up 30, year two, down 20, year three, up 10. Your average return looks pretty good. It's 6.67%. Yes, I did that math in my head. But when we calculate the actual money movements,
Yep.
okay, when we calculate your CAGR, your real growth rate is only about 4.59%. That's more than 2% less than the average return. That's a big difference, especially if you start doing that year over year over year. So over
Correct.
long periods, that small difference compounds into massive gaps inside your portfolio's performance. Okay, so John, any thoughts on that? Because I'm gonna keep going here. I'm gonna plow ahead, but I want to know if you have any thoughts on that part.
Yeah, I'll just say that I think that in my 25 years as a financial planner and advisor, investment advisor, you know, I can't tell you how many times I've had folks, whether they're clients or not, walk into my office and go, "Hey, I see the average returns that are being posted and advertised by the fund that I'm in or by this other investment that I have with a different advisor. And that's why I'm coming to you." And I'll say, "John, I'm telling you right now, I've owned this investment for 10 years and I look at the 10-year average numbers and I'm not anywhere close to this. What am I missing?
Yep.
Why can't I figure this out?" And this is the reason right here. You just literally went through the reason why. And that's why it's very important that you understand what compound annual growth rate is compared to average returns, period.
And guess which one most financial advisors like to use, John?
Yeah, I'm gonna have to guess they love using average returns.
Right, whichever one makes them look better. All right,
Correct.
so why does this matter for you as an investor? Well, I'm going to give you three reasons why I think you should care about this. Um, and there's more than just these three reasons, but these are the biggies, right? Portfolio planning. If you use average returns to plan how much you'll have at retirement, you might overestimate and fall short at the finish
Absolutely.
line. Okay, that's a problem because you can't go back and fix that. Um, the other part of this is risk assessment. You may actually be in an investment that is not aligned with your risk tolerances, which means you might be taking on more or less volatility than you are accustomed to, which also means that you may not enjoy the journey that you're on through all of this. And you may not understand why, because the investment lines up with a rate of return that you're seeking, but it's not actually achieving that particular rate of return, at least when calculated on an average basis.
Yeah, can you
And then,
expand what you mean real quick? I'm sorry to cut you off there, but can you
yeah,
expand what you mean when you say people might not enjoy the experience? Go into that a little bit, just to touch on that a little more.
well, if you think about it, John, I mean, we've said this a lot, right? Money is just the fuel for the journey that you're on,
Right.
right? And what we're trying to do, what everyone is trying to do, is get their money to grow, and for different reasons, for different goals and different aspects of what they're trying to achieve. Risk assessment allows us to put different investments side by side and help you figure out what you might expect as it relates to volatility, the swings up and down in that particular investment. So if a particular investment displays a certain rate of return, an average rate of return, you might attach yourself to that and say, well, that's right in line with what I want. However, in reality, what you're actually experiencing is a lot more volatility, for example, than what you signed up for.
Correct.
And that's really what it means from a risk assessment standpoint. And I
Yep.
think CAGR actually gives you a better way to quantify risk and actually um, it's never going to be perfect, but maybe do a better job of assigning portfolios that are in line with people's risk tolerances. Does that kind of answer your thought there?
Yeah, and in other words of saying that is, if you go to an amusement park and you want to ride roller coasters, but you're not a fan of, roller coasters that have massive peaks and valleys and go upside down and barrel rolls and all these things, if you're not a fan of that, you're not going to want to hop on that roller coaster. You're going to want to know what that roller coaster is doing throughout the ride so that you can understand whether it's the type of volatility you're willing to accept. and
That
and you know what I mean? That's
yeah,
exactly what it's talking about.
that's a real world example that actually happened in our family. I don't like roller coasters, John. I'm not really a big fan of them. And my family knows this. And the risk assessment they assigned to a roller coaster was inaccurate. I took that information and actually got on the roller coaster, and I did not enjoy that ride.
Yep.
Um, that's just how I'm wired. Not a big fan of it. But we had a stern conversation after that ride about risk assessment going forward. So
Yep.
definitely hits home here. I want to give you the third reason. We talked about portfolio planning. We talked about
Yep.
risk assessment. Why should we care about average return versus CAGR and all of this? I think comparing investments, that's what it comes down to from a portfolio standpoint. Because CAGR really is a great equalizer when you're comparing mutual funds or ETFs or private investments or just a combined portfolio. You want to know what was the real compounded performance over time. So let's go back to something we talked about earlier. And I said, put a pin in this. If investment advisors are able to disclose average rate of return and don't necessarily have to tell what the CAGR is, um, why is that important? Well, I think as a consumer, you need to ask for the CAGR. You need to ask for what is the compounded annual growth rate
Yep.
on this investment and be able to put them side by side. And I'll just put it to you this way as kind of as a side note here. If someone is pitching you an investment and only talks about average return without showing the CAGR, I think that's a really big red flag. Okay. I'm
I
just going
agree.
to say it. That's a big red flag. It might mean that the numbers sound great, but under closer inspection, they're not going to hold up to
Yeah.
maybe
So
what you're
like it could be
seeking.
like they had a really, really huge up year, which is
Yeah.
skewing the average numbers, and they've had a bunch of very mediocre or down years.
Yep.
So yeah, I agree 100%.
I think the goal here is we want everyone to be educated consumers in the marketplace. And
Hmm.
a simple way to do that in this aspect is just dig deeper, right? Always ask the person you're talking to, okay, that's great, but what was the CAGR over that same period of time? And if they can't answer that or if they try to avoid that, I think it tells you a lot about that particular individual and certainly the investment lineup there. So that's probably a pretty good side note as a consumer. Stick that in your hat and use it when you're in the office.
Yeah, agreed. And and it's easy for you as well to figure out the CAGR on your own without even having to ask. You just, what the actual, you don't have to ask what is the compound annual growth rate. It's pretty easy to figure it out on your own. If just ask for a year by year uh, look into what the returns are. So if you just get a year by year return on the portfolio, it's going to be you'll be able to figure out pretty quickly just looking at the annual returns year by year how volatile and how up and down that investment possibly is, or that it's actually a pretty darn smooth ride, and the investments are performing pretty close to what the advisor or financial planner, whomever you're dealing with, is representing.
And
um,
one other thing, John, I would say, I think you also want to have some way to kind of like the tent peg out in the field. You want to know what is the benchmark? What was this supposed to do? What is the benchmark for this particular portfolio or this investment? What does it tie to? And then it gives you some perspective around that CAGR as well.
I agree. And now that you brought that up, we can go down that rabbit hole very quickly. Maybe this is we can turn that into a bigger topic and devote an entire podcast on that. But I just want to put it out there as a public service announcement that Folks, the Dow Jones Industrial Average or the S&P 500 or the NASDAQ 100 are not truly your accurate index that you should be comparing your investments to, unless you are only invested in stocks that are represented in the S&P 500, or unless you only own the 30 stocks or companies that are represented in the Dow 30, or if you're only invested in the 100 companies that are in the NASDAQ. Unless that's the case, then those are not an accurate representation of the index you should be comparing your returns to. I know it's great to compare it to those because that is what are most widely used out there. When you turn on CNBC or MSNBC or Bloomberg TV or whatever else you want to look at, it's just not an appropriate way to compare yourself. You need to compare apples to apples when you're trying to determine how you're performing against a specific index or combination thereof. I'll leave it there. We can again build an entire podcast around that topic alone. But Bill, did you have anything you wanted to quickly add
I,
there?
I would just say the metaphor there is like it's almost like taking a little league baseball team and comparing them, to my beloved Philadelphia Phillies, right?
Oh yeah,
Wait a minute, that might not be good. They're playing better lately, but the point is like that's a different league, right? So that your portfolio might be built to do something different, or likely is built to do something different than what the S&P 500 is doing. Now, it's a great data point if you want to look at it, but it's probably not even a kissing cousin to what your portfolio is.
agreed. Agreed. All right, don't want to beat that too hard. Beat that drum too hard. We have plenty of time. We can cover that in additional future podcast episodes.
We'll fight that battle another day, right?
Absolutely. So, all right, let's wrap this up. I think we've hit all the high points that we needed to hit for this topic. So, a quick recap. So, average returns can be misleading, especially if you have an investment that has a lot of volatility involved. CAGR, or otherwise known as compound average growth rate, gives you a true apples to apples way to measure the growth in your portfolio. And we kind of walked through that. Always look past the flashy numbers and focus on the real story that your money is telling you. So that, again, that's just going back to looking at the annual, looking at your returns on an annual basis to determine how you fared and how you performed. And lastly, if you want to see an actual example of this concept illustrated where the highest average returns were not the highest CAGR, let us know. We can send you that information. Or you can shoot us an email, go to our website at crownadvisorgroup.com and request a time to speak with us. But we have actual examples where we can show you 4 different portfolios with each of their average returns over a period of time. And we'll let you guess which one has the highest CAGR. And I'm going to tell you right now, you're going to be surprised at what the answer is. So, again, if you enjoyed this episode, it'd mean a lot if you would hit subscribe, share with your friends, send us a note letting us know your thoughts. It really helps us keep these episodes coming your way. Don't forget, folks, we are financial advisors. And if you're over the age of 40 and you've built wealth, now's the time to protect it from taxes. Give us a call, 704-469-0200, or head over to crownadvisorgroup.com. That's advisor with an O-R, group.com, to schedule a call with us today. And we look forward to seeing you on the next episode. Bill, anything you want to say for closing thoughts?
Nope. I just hope everyone has a great day. Thanks for joining us and spending some time with us today.
Absolutely. All right, folks, have a wonderful time, and we'll see you on the next episode. Take care. Bye-bye.
Bye.